U.S. payrolls added 113,000 jobs in January. The unemployment rate ticked down to 6.6%. But here to jump into the deeper numbers with me is Michael Guyette of Pension Partners. Michael, we saw participation rate rise to 63%. Manufacturing jobs added 21,000, which was better than expected. What's the story here?
The participation rate has been obviously a thorn in the Fed's side because nobody really anticipated that you'd see this amount of people leaving the labor force, causing the unemployment rate to drop.
Right.
In the face of still no inflation and still relatively tepid economic activity. So it's encouraging to see the participation rate increase a bit. It means that there's a little bit maybe some of optimism and hope in terms of the man on the street. On the manufacturing side, I think it's a broader trend as in general more jobs go from the emerging economies, which are going through their own turmoil, and companies are relocating more to the U.S. and kind of reinventing here in the United States. The more concerning thing is still this retail job performance. So we saw quite a surprise in terms of firings there. And this is, I think, again, a moment where the market can question demand pull inflation.
Right.
You have two sources of inflation: cost push, which is commodities; demand pull, which is consumers. If the demand pull story is not there after you had a 30% rise in equities, after the Fed has explicitly targeted the wealth effect, at some point we have to question if last year and what happens now is going to be a readjustment to reality.
Sure. I mean, we saw the average hourly wages were up about 0.2%.
Right.
Well, the work week remained the same. I mean, when you're diving into these numbers, this isn't a great jobs report.
Right.
It doesn't seem like a terrible one, but for investors, when they're going to pull back today and say, what am I going to do from 3 o'clock to 4 o'clock in this market, what do you think they need to do?
Well, I think you're going to have this tug of war between those that will say it's bullish because there's going to be more QE, and those that are going to say it's bearish because QE simply has failed. Failed in terms of achieving the inflation target of the Federal Reserve, and in terms of, in general, increasing the amount of jobs being created in the economy. What's happening with the unemployment rate is a function of the labor participation rate. It's not a function of some kind of increase of growth. So I think that's really going to be this tug of war. I do think the bears, the momentum is more on the bearish case now.
Sure.
Because at some point it's almost like Missouri. Show me that all this stimulus was supposed to work. Show me that all these efforts by the Federal Reserve are translating into the economy. And every single data point so far in 2014, for the most part, has confirmed that it has not worked the way everyone thought.
All right. So then, in a word, do you think the market closes up or down today?
I can guarantee you it will go up or down.
All right. Michael Guyette, thanks so much.
Thank you.
Michael Guyette of Pension Partners. For TheStreet, I'm Joe Deaux.